For example, there is a taxi driver who has 10 billion United States dollars to deposit in the bank. The bank pays you an interest of 100 million USD a year. Keep an amount, for example, 1 billion United States dollars, in case the taxi driver wants to withdraw. The other 9 billion, the bank lends to the grocery seller. The interest rate is 200 million USD a year. This grocer used $9 billion to buy all the baker's bread. At this time, the baker took 9 billion and deposited it in the bank. The bank took this 9 billion United States dollars to lend again. From the initial 1 billion, the bank continuously generates profit. New money is born out of nowhere, but merely from loans. However, the risk occurs when for some reason, both the driver and the baker want to withdraw all the money at the same time. At that time, the bank did not have the money to pay everyone. And this is where the crisis comes. At this point, someone will say that the bank only needs to reclaim the loaned money to be able to return it to the depositors. However, it is not always possible to claim the money immediately. Then take the mortgaged property and sell it and you can pay off all the money. But the problem is that most of the assets used as collateral are real estate. Until the due date, the bank cannot take it away. Especially when the real estate market falls into a period of low prices, banks can't even sell it. Even selling is not enough money to cover the expenses. History has proven it. In 1907, the American banking system fell into a crisis of massive withdrawals. The reason is, when news of a number of banks in New York, including one of the largest banks, Knickerbocker Trust, failed to manipulate, the copper market broke down. In addition to the panic of people after the San Francisco earthquake in 1906, faith collapsed. People competed to withdraw all their money while the banks did not have enough money to pay. The banking crisis caused the stock market to crash. It can be confirmed here. Don't be too trusting when depositing money in the bank. Especially when you play the stock market. The more the time of crisis, the more careful the banks are. Because this group is very sensitive to adverse information of the market in general and real estate in particular.